Guys, thank you so much because I know you guys had to overcome many challenges to be here, and I applaud you for that because you're separating, you're blocking time to pay attention to your success. In case you wonder, who is Tax Coach Susan? I am a Peruvian and Japanese lady. I've been married for over 28 years. And these are some of the pictures with my husband and my son as we travel life. And here is my adorable baby. He's now grown up. This picture, the picture at the bottom is him. He's now 19 years old. For those of you who are parents, you know how much we treasure that amazing, remarkable journey as they grow. Despite the fact that my husband and my son aren't perfect, I think they're totally delightful, extraordinary, fantastic, and altogether honorable people, except the moments when I wouldn't mind if they live in another part of the planet. Just kidding. Okay. But now we are going to talk about the elephant in our business, and that's the tax bill. There is a saying that says, seek first to understand, then to be understood. And you know what? We're going to use that tax elephant as our transportation instead of our frustration. Oh yes, to our wealth destination, guys. So why is this important to you? Because you want a system that is audit resistant, drastically simpler. Why is this important now? Because you do not want to build your business on a shaky, broken ground. Why is this important to you like right now? Because you do not want a tax and accounting chaos monster devouring part of your profit each and every year. See, chaos is like a silent hidden monster. You want your books in order, so your energy, you use that energy to grow your business. Isn't it great to feel like you feel assertive about a tax audit in case that happens? Hopefully that never happens. But even more crucial, you want the truth about your profit and loss. See, only the truth is going to set your business free to continue to make a distinctive difference in the long run. It's the only way that you will really invest your time. And it's going to be, you're going to know whether your time that you're investing, is it an expense or is it an investment for you and your family? See, we're not talking about your accountant knowing the real numbers. We're talking about you. Forbes Business Magazine put an article that said, according to Dave Ramsey, every year more than 2 million taxpayers overpay their income taxes. And we're not talking about pocket change. Oh no. Even the federal government admits business owners overpay their taxes by $50 billion, people. You got to wonder if you're in the equation. And another article, the numbers came back at 93% after this research. More than 9 in 10 business owners were overpaying on their taxes. And this is the painful part. Regardless of whether they were paying for a high-price accountant or not. That means if you're a business owner, there's a 93% chance that you're overpaying. This is telling us that we, not our accountants, but we are the ones that need to take control of our numbers. This was painful, guys, in my experience, is that a lot of business owners do not ever know their true numbers. Take it from billionaire Fertitta. He says you got to know your numbers. It's the most essential part of being able to take your business to the next level, because only the truth is going to set your business free. Don't let you or anyone else kill your business. There's a saying by Jim Rohn that says, don't wish it was easier, wish you were better. I honor you today because you're here. You here tells me that you're fighting back. You're fighting back confusion, procrastination, and distraction, because those are the things that kill it. They kill the profit. Your success is directly related to how you manage your books, people. Let me tell you what happened to me. I started learning about cash management, retirement savings, investment, loans, payroll, and accounting back when I used to work at 3 different banks, leading a team of tellers and personal bankers as an assistant branch manager. During that time, I took several classes in college and attended many seminars. Then in 2008, I founded Safe Tax and Accounting. And this is my actual first office. And this is my second office. Gosh, that's many years ago. And I became a certified QuickBooks Pro Advisor, accountant, and enrolled agent. For those of you who wonders, like, what is an enrolled agent? Well, an enrolled agent is someone who studies a tax law and is registered to practice before the Internal Revenue Service to represent taxpayers anywhere in the United States. But I gotta tell you, I had to study for months to pass a 12 hours exam of many different codes within the law of the IRS. And I gotta tell you, a lot of that in the real life, I didn't use. Yep, I didn't use a lot of that. Because one thing is to study all the tax law, and another thing is like what really happens in the real world, you know? But it did help me big time during audits, however. So during those years of my life, I helped hundreds of entrepreneurs get organized to lower their tax bill the legal way, simple and common sense way. I take classes every year with the IRS and many other seminars to keep up with the tax law. And let me tell you, there's so many different changes. I also represented small and multi-millionaire businesses before the IRS and the state. I saved them thousands of dollars during tax and payroll audits. And actually, let me tell you a quick story. A few years ago, I was contacted by 2 wonderful business owners. They were not yet my clients at that time. Their C corporation was being audited by the IRS. And after their accountant heard about the IRS audit, this accountant did not answer their calls anymore. So they tried to represent themselves. However, it did not go well. A month later, they got in contact with me, totally frustrated. They told me that they could not take it any longer because the IRS revenue agent was driving them crazy. But you know what? Even worse, they got totally lost in the process. So after I took the case, I invited the revenue agent to start coming to my office. And boy, oh boy, we both worked for many hours to get to the bottom of it all. However, since the IRS agent found discrepancies in their C corporate tax return, he, get this, audited the prior and the next year of corporate taxes and the personal taxes of each shareholder for each year. So one audit turned into 9 tax audits. Gosh, I remember he used my spare office for 10 months. During these meetings, there were some times when I did not agree with his decisions, especially the one where he did not want to abate $10,000 penalty. So I kindly requested to have a meeting with his supervisor. You know, I asked him in a nice way, hey, you're doing the best that you can for the IRS. I think it's fair that I do the best that I can for my clients because I wanted that $10,000 gone, you know? I remember meeting with the revenue agent supervisor, but his supervisor, get this, also brought to this meeting another IRS revenue agent, expert in the matter. So imagine, it was me against 3 IRS guys discussing statutory penalties, tax assessments, and tax law compliance. But for me, my only focus was to get that $10,000 abated or taken out, you know? It was a very interesting meeting, I gotta tell you. But I am so grateful to God I got the entire amount abated. And you know what? That was not the only thing I was working on. During those visits, the revenue agent wanted to eliminate more expenses because of the other discrepancies. So it was an intensive back and forth of providing proof or substitute proof to keep those expenses. But I'm very glad that these business owners, they collaborated well. So it was a team effort. Because of these, I was able to save them another $15,000 in other tax assessments. I was so glad. However, I gotta tell you, an audit, it's never fun because it's not a fair fight. If the taxpayer does not know the tax law, it's like putting a child to fight with a teenager. A teenager is always gonna win. From my experience, I gotta tell you, an audit can really affect all parts of our lives, like big time. At the end, I turbo learned a lot through actual experience, and I'm glad that I was able to save them over $25,000 in total tax assessments. These are the achievements I really cherish in my heart because this is what helps me to move forward on simplifying the tax law, not for accountants, but for you, the business owner, so that you can defend yourself. You can defend your profit, So going back to me representing business owners before the IRS, besides all of that, I spoke at meetings about tax updates and tax savings strategy. During that time, I also founded a YouTube channel which gives English and Spanish tax clues or tax information. It is geared to protect taxpayers from the tax maze frustration with easy to understand tax information. So, by the way, I'm going to post my new tax law update for 2021 soon. All you need to do is subscribe and click the bell. And when I have it ready, you'll be notified. So after all of that, I still wanted to simplify the tax code even further so it can be used by a non-accountant to fill the silent gap between several solopreneurs and the IRS, or a solopreneur and the accountant, or a solopreneur and their tax software. So the business owner, not someone else, but you, have the knowledge to be in control of lowering your tax bill the legal way. Similar to when you go to a restaurant, you are the one to request the type of food you want, right? And you can do that when you see the tax through the lenses of the IRS. See, once a solopreneur is the one in charge of lowering their tax bill, they can pick and choose in their best interest what they want under Form 1040. Oh yes. Knowing the rules equals freedom to play. It's like you got to know the rules and you can have so much more freedom. Think about that, Once you know what to do, now you know what you cannot do and you know what you can do. Let me just give you a grocery shopping comparison. When you go to the store, you understand prices and sales, you have a pretty good idea of your grocery bill, and you pay at the register. It's like in this case, let's say her name was Mary, she's in total control of decreasing her grocery bill because she knows on which item she's going to pay full price and on which item she's going to pay sale price. So now imagine Tiffany, we're going to call her Tiffany. She goes to the grocery store right before they close, like right before tax season ends, right? She's not aware about her sales and discounts, and she has no idea of her grocery bill. Then she goes to the register hoping that it's not too much. Since Tiffany thinks, this is what she thinks, but it's not like that, but she thinks that the process of sales and discounts are too complicated and the store will close soon. She just doesn't ask too many questions and just overpays again, thinking that one of these days she's going to find out how it works. Isn't that pure nonsense? In that scenario, Tiffany missed the freedom of being able to decrease her grocery bill way before arriving at the register. And my friends, this is what happens to a lot of people during tax season. Many business owners do their business throughout the year without understanding how taxes work. And they create a profit and loss, but have no idea of how much their tax bill is going to be at the end. Their accountant or their tax software tells them the tax bill. It's not the accountant's fault or the tax software. It is up to us to take control, to take charge of our tax bill. Because for the amount many taxpayers have been overpaying in taxes or wasting energy and time worrying, they could have paid themselves like 10 times by simply blocking some hours to learn about how taxes work and save money, time, and years of confusion. Not just for you guys, but for your children, because they see what you do. This is one of the reasons I wanted to assemble a practical tax GPS so a non-accountant can understand it and actually follow it. However, easier said than done, because the tax rules are over like 70,000 pages long. So, I had to be laser focused on what affects solopreneurs so I can separate it. I actually spent several 12 to 18 hours, days, for months on tax research on my own. And this is apart from my regular CPE tax classes that I usually have to take to keep my enrollment with the IRS. I actually read several IRS publications. I read several income tax books from well-known authors in the matter. I consulted with other experts by taking their tax classes because, I wanted to assemble a map. And so I will be able to give guidance to someone else. I gotta tell you though, it was mind torturing. I just wanted to stop many times, but as you know, many times we're willing to do more for others than we normally wouldn't do for ourselves. And remember the saying, don't wish it was easier, wish you were better. Yep. One thing is to know it, another thing is to explain it. And guess what, guys? Guess what? And this is check-in time. I want a high five if you're there. High five, come on. High five, check-in time. High five, good. Awesome. Digital high five. Thank you. Awesome. I got the high five. I got it. Awesome. Good. Awesome. I got you guys. All right, let's go back. So guess what? I noticed to open the vault, the IRS displays 3 codes, but you really need 4 codes to open the vault. Why? Because it uncovers the beginning point to decode these 3 things. A GPS. Guard your business, prepare and predict your profit, secure more profit. In other words, you guard your business when you understand the tax code to open the right business entity, so you start to lower your tax bill from the beginning. Oh yes. And number 2, here you would understand the secret to expense almost anything, guys, to properly prepare your profit and loss the right way. Not just to avoid a tax audit, but to know the truth about your profit. And number 3, see, by understanding how the tax code works, now you can estimate your tax bill ahead of time. So you can then use the options the IRS discloses to decrease it way before you go to your accountant or way before you use your tax software to do your taxes. See, most people think that paying zero taxes is only for the wealthy. Type a G if you're guilty of that. Type a G. Type a G if you're guilty of thinking that paying zero taxes is only for the wealthy, or that taxes can only be understood by accountants. Are you guilty of that? Or that only accountants can lower taxes? See, here's what happens when you believe those things. You enter into this never twilight zone of tax frustration. You dread tax season. It's like you push it away, you try to ignore it, but it keeps springing back every year, right? But you know why? Because it's screaming for your attention. And maybe you spend more time to get your numbers together. Because for some of you, it's like those numbers are somewhere, but even if you have them, it's like they still look like a spaghetti. And this saying by Albert Stein says, the definition of insanity is doing the same thing over and over again and expecting different results. You know, it's like, okay, remember this article? Over 93% of people were overpaying, right? The most costly mistake you can make is not the trade you choose or the market or the name of your business or the season in which you open your business. It is that we must be the ones in control of the end result of our tax bill. Let me tell you why you might be frustrated or ignoring it altogether. See, the IRS has their own way of organizing their information, and you as a solopreneur, you have your own way. And guess what? Both of them are totally different. So here, I'm going to give you the lenses of the IRS. I'm going to give you 4 secrets. Number 1, how the IRS classifies your income and occupation, the great mystery of the tax rates we pay, walk before you run about profit and loss and balance sheet, and the method the IRS charges you taxes. And then at the end, I'm going to give you this tax audit alert, which I call the forbidden donuts. All right. Type an amen if you're ready to go. Come on, give me an amen if you're ready to go. All right. I see that. All right. Very good. Very good. Awesome. Awesome. Thank you. Thank you. All right. Let's continue. Let's continue. So, secret number 1. How the IRS classifies your income and occupation. Remember, the IRS says there are 3 types of income: active, passive, and portfolio. But then what happens with all these incomes, like ordinary, unearned, portfolio, earned, active, passive, reportable, excludable? It's like, it looks like a spaghetti plate, and or overstressed highway. No wonder you're stressed. It's like, oh, your head, you feel like your head is going to explode. And guess what? Even those 3 types of incomes that the IRS has, they call it different names. Like for active, ordinary, earned, material participation. For passive income, they call it unearned, active, investment. For portfolio, they call it passive, unearned, and investment, which passive is totally incorrect. So be not confused, however. We're going to take over this fascinating tax jungle, guys. And now it's discovery time. So this is what the IRS says, right? I say there is 4 types of incomes, and this is the beginning point to uncover your end result, your tax bill. Here is how the map starts. First, I'm going to give you the main frame, which is the house structure of how the IRS decides to charge you taxes. We're going to start from the root, from scratch. So I want you to look at these 2 houses. One is your first home and one is your vacation home. So this is going to be the beginning point, because any tax law changes, that's like the furniture or the wall of the paint and the walls. But this is the main structure so that you can be guided in the truth, guys. Because remember, the truth is really the one that is going to set our business free. So here it is. The first home, we're going to call it the earned income. The second home, we're going to call it the unearned income. And the first home, earned income, has 2 floors. And we organized it where the first floor is active income, the second floor is ordinary income, and the unearned income second home has also 2 floors, passive income and portfolio income. And there it is. Now the spaghetti plate of several types of income, it's organized. So we're able to now align everything else, guys. This is the beginning point. This is the main frame from where everything starts. Now we can organize the tax rates from hot to cooler, meaning from more taxes to less taxes. How your occupation is placed in this structure. So we have employees, we have business owners, we have investors, and we have retired people, right? This is the way the earned income home looks. Employees are in the active income, and business owners and retired people are charged the ordinary income tax. And I got to tell you this because I know that some of you are self-employed or solopreneurs or contractors. If you're a solopreneur, in other words, you're a contractor, you are self-employed, you are here in active income. Yep, you are seen as an employee, so the charges are the tax charges as an employee. You know, the main difference is the expenses. An employee cannot put expenses. A self-employed can put their expenses. And for passive income, this is the business owner and the investor is here. And in the portfolio income is only investors. So an S corporation, it's going to be ordinary income. And a lot of people think that, oh, if I have a rental and I receive rental income, it's going to be passive. Nope. It's that rental income, it's ordinary income. It's charged as ordinary income, people. It's not charged as passive income. Only sales are in passive income. The sale of your rental property, then it's capital gain, only those are here. This is the truth, you know? And portfolio income, the only people that are there are qualified dividends, because even regular dividends are in ordinary income. That's how the IRS charges. Yep. The truth shall set us free. So here in active income, who are there? Architects, lawyers, artists or contractors, nurses, accountants, doctors. And under ordinary income, the people that live here are retired people, real estate investors, people who live off interest and dividends, which is regular, right? And C and S corporation. Those are the people that are there. And in the unearned income home, in the passive income is people that sell their home or second home, or people that sell their business or real estate property or stocks. And in the portfolio income is people that are investors who receive qualified dividends. Yep. All right. So here you have it. This is how the IRS charges you taxes. And this is check-in time. Let's see. If you guys have any questions, feel free to type it in the chat box for the end so I can answer any questions that you may have toward the end. Okay. All right, so let's go to number 2, the great mystery of the tax rates we pay. Remember I was telling you about being the hot all the way to cool? Well, there are many different tax rates. It looks like a jungle out there, okay? There is federal tax, AMT, capital gains, ordinary tax, NIIT, self-employment tax, payroll taxes, like, oh, another explosion, right, in your head. Well, I put it and I organized it for you guys from top to bottom in order, in a nice, beautiful order. So now you know which one is the highest. And guess what? That's federal taxes. That's the highest. Yep. So let's put it together. Let's put it to work together. Let's put it to work together. Okay. Most common rates, federal taxes 10 to 37%. Social Security, Medicare is 7.65 to 22.2%. If we add up together the federal taxes and the Social Security or self-employment tax, we would start at 17.65% to 49.2%. But I want you to see here that ordinary income has also this big elephant, which is the 10 to 37% federal taxes. Yep. The only thing that doesn't have is the self-employment tax or the payroll tax. And then for the unearned income home, I want you to notice this. The federal taxes is not there. Instead, we have the AMT and the capital gains. Remember, I was telling you this is only for people that sell things, right? If you receive rental income, it's not here. The IRS doesn't see it, doesn't charge you as passive income. Yeah. And then we have the qualified dividends here that has less tax rates. So there you have it. The tax rates that apply to each floor depending on where you are living. All right. And now, secret number 3. Walk before you run with your profit and loss and balance sheet without the high tech. Because I know a lot of you get stuck with having to learn QuickBooks, yet you really didn't understand how a profit and loss works. And if you have pen and paper, this is your time, people, to write. All right, so let's go. You have different options to do your profit and loss and balance sheet. You can do it by hand. You can use Excel or Sheets, or you can use QuickBooks. If you do it by hand, you can't digitally share it. It takes time. You can make errors. You can lose it. You can get it wet, not a long-term use, right? If you use Excel or Sheets, however, it's perfect to start. You can save it digitally. You can share it. You can do automatic calculations. You can save time. And you can actually save it every month. And you can use it short-term when you first start, or you can decide to use it for the long term. And guess what? It's free. This is the beauty. It's free. QuickBooks, you must know the profit and loss and balance sheet already. You need to really have understanding of that before you use it. And then you have the monthly membership. Then that's the tech learning curve. Then you have so many choices, you're not sure which one to use. So that's how come people put it off for months. So with this thing about walk before you run, I want to show it to you with 2 file cabinets. Notice the 2 file cabinets. I named one profit and loss, and I named the second one your balance sheet. The top is the bigger one, and then there are two drawers at the bottom for each one. A profit and loss has income on the top. We're going to pretend that the income is at the top, the expense and the net profit is at the bottom. It is called net profit or net income or net profit and loss. There's so many different names, and no wonder people get confused, you know? So you have net loss or net profit. And then for the balance sheet, we have assets at the top, at the bottom, liabilities, and we know liabilities is loans, right? And then equity. Then I want you to look at it this way. Whatever comes from income is going to be spent, and then we're going to have whatever left over. So it comes from top to bottom. Whatever we have in assets comes from either a loan or comes from the money we made in our business, or it comes from our pocket. So whatever money is in our bank account, it comes from liabilities or equity. And then let's look at it with dollar signs. Let's say you have two monies here under income. If you spend one of those monies, of those dollar signs, you have one left over, right? So, and then we go to assets. Let's say that you have three monies there. We realize that the reason why you have three monies there is because one of them is a liability, and one of them is the net profit, which is in the profit and loss. You see, I try to put in the same color. And then you notice that the other dark green dollar is in equity because it comes from the pocket of the owner, or it comes from last year's net profit, last year's net income. Whatever was left over that they earn, we're going to look at that dark green as that retained earnings that were retained from prior year. All right, so now income, we know that comes from clients. It doesn't come from our pocket, right? It doesn't come from loans. It comes only from clients. And that's very important to understand, that income only comes from there, because what I've noticed is that sometimes the expenses that are supposed to be for vendors, sometimes expenses of money that is taken out for the owner's use is put in here, you know? So income always going to come from clients, and expenses are going to go to vendors, and whatever is left over is your net profit. And for the balance sheet, we know that whatever liabilities are there is going to come from a loan, from the bank or from your friend or your family, right? That you got a loan from, and that's how come you have it in there in assets. And then equity is prior year earnings, or the money from the pocket of the owner, and present earnings. All right, and there you have it. Now let's look at it with dollars. This is action with money. So income, in this example, there is $100,000 that this client received. So in total income is that amount. And then let's say that they spend $60,000. So now we have a net profit, $40,000 left over. If I add up the $60,000 that I spent with the $40,000, equals my $100,000, which is the money that I received in income. So now I know what happened. I know that the reason why I have $40,000 is because I spent $60,000, right? And the reason why I spent $60,000 and have $40,000 left over is because I received $100,000 in sales and commissions. So now let's look at the balance sheet. Let's say that you have 3 bank accounts, a checking account with 40,000, a savings account with 21,000, and another savings account with another 21,000. So the total there is 82,000. But when we realize that the checking account is like, oh, wait a minute, the $40,000 in the checking account that I have is because of my net profit that I earned this year. And then the savings accounts have that retained earnings of $21,000. And the other $21,000 that I have in my savings account is because maybe I borrowed from the credit card. It was a loan. So now I know that the $80,000 that I have in the bank account, it's not on mine, right? Because I owe these $21,000. And these $21,000, that dark green one, came from prior years, or maybe from my pocket, earnings from prior years. And the 40,000, I know that's my earnings for this year. So there you have it. Both of them together. And now, doesn't that make sense? If you have any question, guys, you can just post it in the chat. And now let's look at it in an Excel format. Here is the profit and loss, and here is the balance sheet. You have the $100,000 in income. We have the $60,000 in expenses, and our net profit is $40,000. If we go to the balance sheet, we have the checking account with $40,000, the savings account with $21,000, which is from a credit card loan, which is in liabilities, right? And then we have $21,000 in savings that came from prior year earnings or from my pocket, perhaps. Either one of those. It's in retained earnings. That's what they call retained earnings. And then the $40,000 that I have in my checking account is because I earn it here, net profit from present year. But you know what? Don't worry, because if you're still like, wait a minute, but like you got it now, but you're thinking to yourself, oh my God, but there's so much more numbers. I actually prepared for solopreneurs an entire complete profit and loss in Excel that you can use in Excel or Sheets. Here is your income. Here is your expenses. You're able to put even your miles. And I show you how to organize your bank accounts, because that's another confusion out there. It's like, how many bank accounts do I have, and blah. And you see those little red dots. I don't know if you're able to see those little red dots. That's me. That's me talking to you guys. Like everywhere, there's all these places, that's like me telling you, hey, when you like, this is how this functions. And this is the balance sheet. All kinds of little notes here. This is me with a lot of notes telling you and guiding you through the process. And Tony Robbins says, see things as they are, but never worse than it is. See, that mindset is the one that will help you to stay successful. Give me a high five if you agree with that. If you agree with that, give me a high five. Awesome. Thank you. Awesome. All right. See, the moment you see it as it is, it's also the moment you can hope to make it better than it is. Think about that. All right. If you have any question, guys, remember you can post it on the chat for later on. Okay, guys? All right, let's go with secret number 4, method in which amount you pay taxes. This is another one that's so misunderstood and very crucial, very crucial. I want you to think about this. When you go to the store, you get a receipt. You understand your receipt. The subtotal, they call it subtotal before they charge you the sales tax. Some of the receipts may say order total, right? And so after you got a subtotal, you get a sales tax. They charge you sales tax. So in reality, it's called sales tax subtotal. We can call it that way. Well, for the IRS, when you do your taxes, your receipt is your Form 1040. And instead of them calling them sales tax subtotal, it's called taxable income. That's why taxable income, you knowing what taxable income means, is very important. Because with a store receipt, you probably spend $100. With here, it's thousands. Because remember, taxes are our biggest expense. And guess what? There isn't only federal taxable income. There is AMT taxable income, depreciation taxable income. There is corporate taxable income, capital gains taxable income, payroll or self-employed taxable income, net investment taxable income. Right now, we're going to talk about federal taxable income. This is the major one that you want to be aware. And depreciation taxable income. That's like really big in the payroll and self-employment taxable income. Remember we talked about the tax rates? We put it organized. Well, this is the Form 1040. And toward the end of the first page, it says taxable income. So how do we arrive there? I want us to think about this story of Dave and Zena. They are married. Together, they made $134,800. They have $10,000 of adjustments, and adjustments in your 1040 is really deductions to income. If the IRS would have put deductions to income, a lot more people would have been paying attention. Yep. A lot more people would have been paying attention. But they put adjustments to income and people do not pay attention to that. That's very important. So in this case, they got $10,000 deduction. So their adjusted gross income comes out to $124,800. And we deduct the standard deduction and we deduct the QBI for those people that have businesses. So now is when we arrive at the famous, most crucial taxable income that many people are not aware to really take control of this number. They just let it happen. And that's what I want people really to be more in control. So that's why my mission is to help business owners regain their decision power back, because it's been taken away by tax law complexity. So it's time for a business owner to be empowered to decrease their tax bill by understanding. And this is the beginning of it. So let's look at it in a federal Form 1040. We have the total income, $134,800. We have the deduction to income of $10,000, which the 134 minus the 10 equals 124,800. And then we have the deductions of your standard deduction and your QBI. And now we have the famous taxable income. This right here is the amount that you pay, the big tax elephant, the biggest one, the federal tax rate from 10 to 37%. That's only one, because the other one that you pay at this amount is also the payroll or the self-employment tax, which is another 7.65 to 22.2%. Yep. All right. Check-in time, guys. Has this been helpful to you? If so, type a high five. Give me a 5. Come on, type a high 5. All right. Very good. Very good. Awesome. All right. Very good. So let's recap. Four secrets. Let's do a quick recap. So, number one, you must see your income through the lenses of the IRS. Otherwise, you will not know how to read your tax receipt or tax bill to decrease it. Number two, we've seen that this is the beginning point to know which type of business entity you should open based on what tax rate applies to your business or what tax rate applies to your income. And number three, learning first how a profit and loss works with the law tech is like learning how to walk before you run, right? Or like learning how to drive your car before you start driving. See, once you know how to drive, think about it. Do you go and you wonder how you're going to drive? Once you know how to drive, you just go in your car and you start driving. That's how profit and loss and balance sheet is. You know, once you know how it works, you just do it. That's all. And number four, it is insane not to know on which amount the IRS charges the different tax rates, because knowing how to decrease the subtotal is the beginning to protect your profit. And you will be able to decrease it even more by estimating your tax bill way before tax season. Yes. I got to tell you, if you're here, it's not an accident. You're here for a reason. And this is for solopreneurs. This is for contractors, freelancers, self-employed people. If you're a YouTuber, coach, multi-passion, podcaster, expert, blogger, driver who has a small business, or you're starting your own business, this is for you. And so now let's go to the bonus alert. Remember I was telling you about the bonus, the audit alert? So this is something that you do, that some people, a lot of people do, because I've seen it in all those years working with clients. You actually, when you do this, you actually push the IRS agent out of his desk. Like, he wants to work and he doesn't want you to bother him. But when you do this, you're like pushing him out of his chair saying, audit me, audit me. And he doesn't want to, but you're pushing him out of there. This is what happens when you do this, guys. And I call it the forbidden donuts. And this is it. Think about it. When you put an expense and in your taxes, do you put $801, $807? See, a lot of people would put 800, 700, 400, 300 in their expenses. And it's like, look at this one. Which one looks more accurate? Which one do you think the IRS, when they see, they're going to say, oh, wait a minute, that's not real. $1,000, $500, $4,000, $200, that's not real. No way. These people are estimating, and who knows how they are estimating. It's like you're letting them know you're estimating. But you know what? You have two options. When you estimate, you actually have two options. You can estimate, you know what? It's about $1,000, but if I estimate a little closer, it's really $918. So you can still estimate, but please do not estimate with zeros, because look at which one looks more accurate to anybody. So never, ever use that many zeros when you do your expenses, when you put your expenses on your Schedule C, or when you do your taxes. It's time to set new standards. We cannot just continue on the way it's been. We have to break through. It's time to defy the odds, because most people, they just continue doing the same thing over and over. And that's what we call insanity. Continue to expect different results. And you can become solopreneur 2.0. That's the way you become solopreneur 2.0. Yes, we are always, yes, we're going to make this tax frustration our transportation to our well destination, you know? The regrets of tomorrow can be fixed today. We are always creating serenity or frustration with every decision we make. And that's true. Every decision we make enables us to bring peace or to bring worry into our lives. And this is it, guys. From my heart to your heart, guys, I really thank you. I appreciate you big time because you black time to pay attention to this elephant that's in the room, which is your biggest tax expense. And it's there. A lot of people don't want to see it, but it's a big tax elephant. And you separated, you block time to be here. And that tells me you're on your way to make that tax elephant frustration into your transportation. So applauses for you guys, applauses. And I want a high five. Come on, people. I want a high five before I go. Come on. And good. I see I took notes. Awesome. Great stuff. Very good. Thank you for your time. Very informational. Awesome. Thank you so much. I appreciate it. Thank you. Thank you. And a big hug for you guys. Thank you so much from my heart to your heart. Thank you. All right. Bye-bye, guys.